Canadian oil and gas stocks are set up amazing, and as the market panics and the price of oil drops, there is a massive opportunity for investors right now. Today, I want to talk a little bit about what has happened with the price of oil over the last couple of days. I'm going to digest a little bit about this. I have heard from some experts in the area. I have been really diving deep into what I think the potential could be, and I believe that Canadian oil and gas stocks are the single best opportunity in the energy market right now. And they're trading at a fantastic price. Welcome to Larch Investing. My name is Liam. Here on the channel, we talk about Canadian investing. We've been diving deep into the energy space over the last month or so because I have seen some huge shifting potential gains, and I believe there's an asymmetric return potential in these markets. Feel free to check out any of the videos we've talked about this stuff. Today, we're going to focus on a couple key items. We're going to talk about the OPEC Plus move. We're going to talk about the price of oil. We're going to talk about the potential long-term impacts of tariffs on the oil price. And then we're going to talk about why Canadian companies are so perfect for investors right now. So let's start with the OPEC Plus move. Now, understanding this is a little bit complicated. And so I've relied a lot on experts in the field who have contacts, who've talked to people, and who have been sort of sharing what they've learned. A lot of the move that we've seen down in oil prices comes directly from OPEC Plus, because they have announced that they are bringing forwards a huge amount of production compared to what was expected. And of course, that has dropped the price of oil. However, I don't think we should be quite as scared of this as investors have been. And that's thanks to a couple of reasons. And the first one is the fact that for the last while now, everyone in this space has understood that OPEC Plus has a huge amount of reserve production on the sidelines that they are holding off on simply because of deals they've made to keep up the price of oil. This has meant that at any moment, they could make a decision that tanks the oil price, which clearly they have. Now, as they make these decisions, as they allow this production to come online, we're going to see that anchor, that weight around the market suddenly let off a little, which means it's a lot safer to invest because you know that tomorrow there won't be an announcement that destroys your investment. The second item here, and I'm relying a lot on Eric Nuttall and a lot of the work that he's done talking about this for this. But apparently, according to his sources, his experts, a big part of this move was because OPEC Plus members were already producing a lot of this oil. And the members that were following the rules are simply coming more in line with the members cheating. Now, the ones that I heard him mention were Kazakhstan and Iraq. But of course, I think this just shows that while we in the West like to picture OPEC Plus as this unified entity, we think of them as sort of one thing. It really is just a bunch of different countries working together to benefit the oil market. Of course, when countries cheat, you can't expect the other countries to simply follow the rules for the good of the market itself. All of these countries, like everybody else, is in it for themselves. Speaking of countries being in it for themselves, let's talk a little bit about the tariffs. Now, this is a huge hornet's nest, and I know it has become really political. And so I'm not making a political statement here, but I do want to talk about what these tariffs mean for the price of oil, both short and longer term. One of the big impacts that has dropped the price of oil has been the tariffs. And it's not really that we're tariffing the energy, not that the Americans are doing it, not that any of the rest of the world are going to put counter tariffs on them, but instead what those tariffs mean for demand. Demand growth is incredibly important for the price of oil. And of course, demand growth is going to slow if we don't see quite as much investment into production. And investment only really comes from a place of stability. And I don't think it is arguable that right now things are stable. The VIX has spiked up into the 40 range. That's something we haven't seen since like COVID. And I know that was only 5 years ago, but before that, we're talking 2008. Before that, we're talking .com bubble. These are these huge moments in time where the economy really shudders and things are in real danger and recession is on the horizon. All of that being said, I don't know exactly how the tariffs are going to play out long term. And while I've seen predictions like, we're saying that maybe demand growth instead of 1.2 million barrels a day, it's 200,000 barrels less than that. But apart from predictions from experts who say they kind of understand, I don't know what is going to play out exactly, but I do know that volatility is not good. And regardless of how long the tariffs last, the volatility has already had an impact. There are companies who are already not making investments because of these tariffs. There are companies that will fail regardless of how long this policy continues for or how good it is for any one nation. And the counter tariffs are just going to continue this story. It's going to dominate headlines until we see some sort of resolution. And because of that, you should expect that prices will continue, if not to fall, at least to stabilize at these lower levels. But like I said, I think this is a huge opportunity for us as investors. I am a young investor with a long-term mindset. And if you are in the same kind of boat, maybe you have a long-term mindset, maybe you're really young and you have a long time to invest, you have a huge opportunity right now. Because Canadian companies have been dropping with the overall oil market. And I think that's a huge mistake. The price of oil right now is sitting at like WTI, maybe $60 a barrel. Obviously, it depends on when you're watching this video. But at those prices, very few production companies, oil production companies around the world can invest into their own production. $60 oil is like just breaking even, just paying the bills. And that means there's a lot of companies that aren't going to be able to grow the way they wanted to. They're going to suffer. There's going to be turmoil. There's going to be trouble. And they're not going to be able to continue growing the way they expected to. And if they do, they are putting themselves at huge risk that maybe things continue to get worse. But there is one part of the world where the oil companies have been cutting out debt, where they have not really been growing that much, where instead they focused on the balance sheet, and where they are some of the lowest cost producers on earth. And of course, if you watch the channel, you know these are some of the big points that have made me so bullish on Canada. These companies are incredibly well positioned for the current scenario. CNQ, for example, a massive Canadian juggernaut, has had its stock slashed. The price has tumbled, and yet they are still cash flow positive. They are still holding on to long-term, really valuable assets, and they are still sitting on money. They have cut down debts from historic levels, and they are in a really good position. And that's just them. There are smaller companies in this marketplace that are actively buying back fantastic amounts of stock. Now, I will do a video talking specifically about this, but that's a huge opportunity right now. And if these companies are willing to be shoveling money into their own stock, I think we should pay attention. Because what really is going to be the impact of all of this negativity? Production doesn't grow as fast in the short term, right? Hurting short-term producers with short-term assets. US shale is looking like a twilight. I've heard, again, I'm referencing Eric Nuttall here and lots of other experts, but I've heard people saying that the sort of end in production growth for the Permian, or at least the slowdown, could be now, could be 2025, Q2. And of course, those companies are getting hurt. The Permian is running out. All of a sudden, even the US demand that is there is going to need somebody to provide oil. And Canadian companies are sitting here at discounts with long-term assets that aren't even faced by the current problems, that don't even care what's happening in the market right now. Because in Canada, we've seen the differential shrink to not historic, but at least like 4-year, 5-year lows. Maybe more than that. Actually, I've seen some people mention like 15-year lows. I don't want to jump the gun on that, but we've seen it in the 8s and the 9s. Single digit differential between WCS and WTI. We've got LNG Canada coming online. Natural gas is still in great demand. Who cares about the tariffs and the potential slowdown? There is still going to be huge demand for natural gas. We've got countries still building coal power plants. You don't think they want natural gas? So LNG Canada coming online is huge. And of course, they're well-capitalized companies who can just wait this out. And so when we see their stocks getting offered to us at massive discounts, when we see this hurting all of their competition, when we see the weight being lifted off the neck of the market, and when we see political will in Canada to finally invest in this space, to put public money into infrastructure that will benefit these companies, I don't see the argument for their stocks dropping this much. Why should they drop the same way that Exxon does? Why should they drop the same way that Shell does? Right? These multinationals are going to be hurt by all this bad news. But Canada's companies are actually in a fantastic position. And I think that right now is probably one of the best buying opportunities we're going to get. But I do want to say, as bullish as I am, I think this is an important note, because I've seen a lot of people mention this when we're talking about buying the dip. You should never time the market entirely. You shouldn't put all of your money right now into a single company, but instead follow what I've been doing. Dollar cost average. I bought shares of C&Q when it was, November, when things were pretty good. I bought more shares in January. I'm buying more shares right now. I'm going to buy more shares next week. That means that I am going to find a really solid average price, and I'm not going to be hurt too much by any spikes or sudden dips in the stock price. Buy the dip, absolutely. But don't spend all your money at one time, because if we see the market fall 10, 20, 30% next week, you're going to wish you had some money on the sidelines. So that's what I'm doing. That's what I think. I really strongly believe in this market. I've seen a lot of experts that agree with me on this, that are putting their money where their mouth is, and I'm doing it too. I am actively investing in large cap Canadian oil and gas companies, and I think that's a really great space to be. Thanks for watching this far in the video. If you made it this far, again, please do like the video, subscribe to the channel. It makes a huge difference and it doesn't cost anything. And if there's any specific companies or sectors or even just topics you want me to cover, please drop a comment, let me know. With that being said, I really do hope I see you in the next one.